Good evening. Tonight, we're bringing you a story that's sending shockwaves through the world of streaming and finance alike. On January 21st, 2026, Netflix released its financial results for the last quarter of 2023, beating Wall Street's expectations in both revenue and profit. The numbers were impressive, with revenue growth outpacing forecasts and profits coming in stronger than analysts had predicted. For most companies, this would be a cause for celebration, a clear sign of strength and momentum. Normally, this kind of financial performance would send the stock price soaring as investors rush to buy shares in a company that's clearly outperforming its peers. But instead, in a surprising twist, Netflix shares tumbled in early European trading, catching many by surprise and leaving market watchers scrambling for answers. Why did this happen? The answer lies in Netflix's latest move. The company is now in a high-stakes battle to acquire Warner Bros. Discovery, a bold and risky play that's making investors nervous about the future. The company's strong performance was quickly overshadowed by the uncertainty surrounding this potential mega-deal. Investors are now weighing the risks of such a massive acquisition, wondering if Netflix can successfully integrate Warner Bros. Discovery, or if it's biting off more than it can chew. Investors hate uncertainty, and this acquisition could either secure Netflix's dominance in the streaming wars or become a costly misstep that haunts the company for years to come. The stakes couldn't be higher, and the market's anxiety is palpable. The stock dropped 7% in Frankfurt, signaling global concern about the risks Netflix is taking. This sharp decline reflects not just local sentiment, but a worldwide unease about the company's aggressive strategy and the potential fallout if things don't go as planned. Today's story isn't just about numbers, it's about strategy, ambition, and the market's reaction to risk. It's a reminder that even the strongest financial results can be overshadowed by uncertainty and bold moves that challenge the status quo. In this episode, we'll break down why strong earnings led to a falling stock price, what share buybacks mean for investors, and how the Warner Bros. Discovery bidding war is shaking investor confidence. We'll also explore what's at stake for Netflix and why this moment could define the company's future for years to come. This is a pivotal moment for Netflix, revealing the delicate balance between performance, ambition, and market trust. The next steps will be crucial, and the world is watching to see how Netflix navigates this high-wire act. Let's dive in. When a stock drops 7%, it means investors are suddenly valuing the company much lower, sometimes in just a matter of minutes. This isn't just a small dip, it's a dramatic shift in how the market sees the company's future. A 7% drop can erase months of steady gains, and it often signals that something has changed in the way people feel about the company's prospects. Billions of dollars can vanish in hours. For a company as large as Netflix, that means a huge amount of wealth is wiped out almost instantly, affecting not just big investors, but also regular people who own shares through retirement accounts or mutual funds. For Netflix, this doesn't mean the business itself is suddenly worse. It's about how risky investors think the future is. Stock prices reflect confidence. When that confidence is shaken, prices fall, even if the company's day-to-day operations haven't changed at all. It's a signal that investors are worried about what's coming next. A big drop can hurt retirement funds, making people anxious about their savings. It can also impact pension plans and college funds, since many of these are tied to the stock market's performance. It can make it harder for companies to raise money and signal trouble ahead. When stock prices fall sharply, companies may struggle to borrow or invest in new projects, slowing down growth. In this case, the 7% fall is a clear sign of anxiety about Netflix's next move. Investors are reacting not just to the present, but to uncertainty about the future. Investors rush to sell, pushing the price down further. This creates a feedback loop. Panic selling leads to more panic, and the drop accelerates. The key question: what spooked them, despite Netflix's strong results? Why did confidence evaporate so quickly? The answer isn't in what Netflix has done, but in what it's planning next. Investors are always looking ahead, trying to predict the company's next move and how it will affect future profits. Let's look at why good news wasn't enough, and why sometimes even strong results can't calm the market's nerves. Netflix beat expectations for the fourth quarter, usually a cause for celebration. But the market is forward-looking. Investors care more about the future than the past. Netflix's announcement of a major, risky acquisition overshadowed its strong results. It's like a straight-A student suddenly announcing they're dropping out for a risky startup. Investors had to weigh the certainty of great earnings against the uncertainty of a giant takeover. The fear of the unknown proved stronger than the comfort of recent success. Netflix's pivot to a massive acquisition forced investors to rethink the company's risk profile. The result? A sharp drop in stock price, despite stellar performance. 9. Netflix's pursuit of Warner Bros. Discovery is no small move. It's a potential mega merger. WBD owns iconic content like HBO, Harry Potter, DC Comics, and CNN. Acquiring WBD would instantly give Netflix one of the world's most valuable content libraries. But Netflix isn't the only bidder. A fierce auction is driving the price up. Winning means paying a massive premium, potentially hundreds of billions. Strategically, it could make Netflix the undisputed streaming leader. But merging two giants is complex, expensive, and risky. Investors fear Netflix could overpay, take on huge debt, and lose financial flexibility. The grand vision is clear, but the risks are enormous. That's why the market is so uneasy. Netflix also announced it's pausing its share buyback program. A buyback is when a company buys its own stock, reducing the number of shares and boosting the value of those that remain. It's usually a sign of confidence and supports the stock price. By pausing buybacks, Netflix is signaling it needs every dollar for the WBD bid. This removes a key support for the stock and makes investors nervous. The company is redirecting billions from shareholders to fund the acquisition. It's a clear sign Netflix is all in on this deal. But for investors, it means less immediate return and more risk. The pause is a practical move, but it's rattling the market. 10. Pausing buybacks was the tipping point. Investors lost a reliable way to boost share value, trading certainty for the gamble of a mega merger. The benefits of acquiring WBD are years away, if they materialize at all. The cost of pausing buybacks is immediate and concrete. It signals just how expensive and risky the bidding war has become. Investors fear Netflix will take on crushing debt, limiting its ability to invest in new content or respond to competition. The company is now seen as a high-risk acquisition vehicle, not just a streaming leader. The 7% drop is the market's gut reaction to this new risk. Investors are heading for the exits until the future is clearer. 10. The recent 7% drop in Netflix's stock price is just the latest chapter in a much larger story, one that's been unfolding for months. Since the bidding war for Warner Bros. Discovery kicked off in December, Netflix shares have tumbled by a staggering 20%. This isn't just a blip. It's a sustained slide that's wiped out billions in market value and rattled even the most loyal investors. Every new rumor, leak, or official update about the potential deal has chipped away at investor confidence, making it harder for Netflix to regain its footing. The company's decision to pause its stock buyback program was the final straw for many, sending a clear signal that management is bracing for uncertainty and possibly higher costs ahead. This isn't just a knee-jerk reaction to a single day's headlines. It's a response to a fundamental shift in Netflix's strategy, and the market is clearly skeptical about the direction the company is heading. What was once seen as a bold move to acquire Warner Bros. Discovery has, so far, turned into a nightmare for Netflix's stock chart, with each passing week bringing more uncertainty. It's like watching a tire with a slow leak. Every new report, Every analyst downgrade just makes the situation worse, draining confidence and momentum. The 20% drop is more than just a number. It's a resounding vote of no confidence in management's vision and their ability to execute under pressure. Now, Netflix's leadership is under the microscope. They're being pushed to either close the deal quickly and prove the doubters wrong, or take decisive action to stop the bleeding before more value is lost. The market is demanding answers and real results. The next few weeks could define Netflix's future as investors watch closely for any sign of a turnaround. The stock market runs on emotion, mainly greed and fear. Right now, fear is winning. The unknowns around the WBD deal, price, integration, payoff, are fueling anxiety. Many investors are choosing to sell now and ask questions later. This herd mentality can turn a small dip into a major drop. Netflix's leadership must calm these fears and present a clear, credible plan. Until they do, the pressure on the stock will continue. The market wants reassurance that this gamble is calculated, not reckless. The future of Netflix and streaming hangs in the balance. 10. Netflix's stock drop is a lesson in Wall Street logic. Great results aren't enough if the future looks risky. The 7% decline and 20% since December reflect deep investor unease about the WBD bid. Pausing buybacks signaled Netflix is prioritizing a risky acquisition over reliable returns. This is a defining moment. Netflix is betting its future on a single, massive deal. Investors are worried about debt, risk, and execution. The outcome will shape not just Netflix, but the entire entertainment industry. For now, the market is skeptical. Will Netflix's gamble pay off or become a historic blunder? The next chapter in streaming will be written in the boardroom, not on screen.